Welcome to FinStreet. Now we are talking about the Q2 FY23 performance of the banking sector, which was one of the best in last 7 years on several counts, including the profitability and the asset quality. Let's begin with asset quality. Over the past few years, the banking sector has been weighed down by the asset quality issues. It began with AQR, or the asset quality review, and was followed by the COVID-led downturn. So with NPA surging to 10% post AQR to around 11% post COVID. But banks have bounced back strongly since then by making prudential provision and writing off elevated stress from their balance sheet. Other measures like restructuring as well as sale to ARC or the asset reconstruction companies have also helped in lowering the immediate burden on the P&L. The gross NPAs of the banking sector have declined to 5.24% when compared to 5.94% in the previous quarter. This was largely led by the fact that PSU banks' gross NPA is down to 6.53% when compared to 7.51% in the previous quarter, while private banks have seen their gross NPA ratio decline to 3.11% when compared to 3.36% in the previous quarter. Slippages or formation of bad loans, the PSU banks have seen this decline sharply by 30.7% quarter-on-quarter, resulting in an annualized slippage ratio of a mere 1.42%, while slippages for private banks have also declined by almost 9% quarter-on-quarter, leading to an annualized slippage ratio of around 2.3%. Even the restructured book of the banks is now down to 1.64% when compared to around 1.9% in the previous quarter. It had hit a high of 2.7% post the COVID impact. Interestingly, core provision coverage ratio of PSU banks has been very healthy at about 74.7% when compared to 74.4% for the private banks. So for past 4 quarters in a row, the PSU banks core provision coverage ratio has been more than 70%. The banking sector has reported its highest quarterly profits in last 7 years or 28 quarters. So profit for the sector stood at more than 58,700 crore, a growth of 59.3% YOY and about 33.2% sequentially. The rise in profits was led by strong loan growth, which actually aided in the net interest margin improvement on a sequential basis. Now treasury operations turned profitable for many on a quarter-on-quarter basis. The credit cost had declined, or the NPA provision had declined as well. So what to expect going ahead? In a rising interest rate scenario, you can expect the net interest margin to continue to see improvement over the next few quarters. Deposit growth is a worrisome factor for some of the banks who have the credit deposit ratio above 90%. So loan growth to remain strong as corporate demand is back to banks due to elevated money market rates. So credit cost to decline led by lower slippages going ahead. Asset quality will improve with better recoveries. Return ratios to remain healthy at least till Q4 FY23, aided by the net interest margin improvement.